In this video, I'm going to give you tips for creating your cash flow statements. So you've been assigned this duty, and now you're scratching your head and wondering, how do I do this? So I'm going to give you some key steps to help you create the cash flow statement with confidence. So let's take a look at cash flow statements. So as we go here, we see the cash flow statement. We also see the balance sheet. First thing I want to explain is this cash flow statement is really here to tell us a story about how the company goes from 190 in this example to 627. We see those same numbers here at the bottom of the cash flow statement. So this statement is all about the cash that's coming into the company and the cash that's going out of the company. One of the confusing things about cash flow statements is we have accrual accounting over here on the balance sheet, and now we're trying to get to just pure cash. So if you think about cash flow statements, think about having three buckets, and those buckets would be one for operating activities, the second for investing activities, and the third for financing activities. If you could somehow magically have these three buckets and see the amount of cash going into each of those buckets and the amount of cash going out of each of those buckets, then you'd have a net amount based on what went in and went out of each of those three buckets. That's really all the cash flow statement is. The thing that makes it confusing is over here we have accruals. Over here we do not. And so one other thing I need to explain very quickly is some people do direct method cash flow statements. That would be what this looks like here. So you're seeing cash coming in from customers, cash being paid to employees, say for salaries. You're seeing proceeds from the sale of assets. That's direct cash coming in and out. But most small companies will use what's called the indirect method for the cash flow statement. When we have an indirect method, we start with the net income of the company, and then we're working toward the net cash flows from operations. So notice this number is the same as this number. If you have the indirect method statement, you're going to see this part up here. It'll replace this section. So now one of the tips I want to give to you is I want you to think about those three buckets again: operating, investing, financing. How much cash is going in, how much cash is coming out. And focus first on the investing activities and the financing activities. Now, why do I say this? Because these are direct cash flows, and direct cash flows are easier to deal with than the indirect method down here. So what we're trying to do, if the company is using the indirect method cash flow statement format, we're starting with the easier parts, the investing and financing. So down here, on the operating part, we're going from net income to the actual cash flows from operating activities. Up here in the investing and financing activities, there's no reconciliation like this. So we start here with the easy parts. So we can look and see how much cash did the company receive from selling, say, equipment, or if they sold a building, then that's pretty easy to come up with. They got a check when they sold these assets, and they put it in the bank account. So that's how much cash came in. If they're buying equipment, then money's going out. So sometimes you'll see here purchase of fixed assets. Now here they're calling it capital expenditures, but they're buying assets. If they're buying assets, they're writing a check. Again, pretty easy to chase that down and know what that number is. Same thing here on the financing activities. Now, financing deals with money that's going in and out from the owners, but also money's going in and out from lenders like banks. So in this example, we've got payments, we've got payments going to a lender for $400,000. Again, this is a check. They wrote a check for, say, $400,000 on October 1. Well, that's easy to chase down. So we have direct cash flows for investing and financing. So what I want you to do is start here, obtain these totals for those two parts. And notice that we have the cash at the end of the year. It comes from here on the balance sheet. You'll have an easy time because you normally develop your balance sheet first. So then you know that this number is going to be this number. And then you know that the 190, the cash at the beginning of the year, it's coming from here. So you know what this number is, you know what this number is, you know what the cash flows from financing activities is, you know what the cash flows from the investing activities is, and then you can back into what the cash flows from operations is. Now, I like to do this before I start working with this indirect piece down here. Once I know what this number is, then I'm going to drop it in down here. And then my net income number is coming from the income statement. And when I look on the income statement, I see net income. The balance sheet and income statement are relatively easy to create. I would do those first, and now I have my net income number, which is going to go here. I have backed into the cash flows from operations, so I know what that number is. Now I've just got to work through this process to get here. So I started with this number, the cash at the end of the year. Then I know what my beginning cash number is. Then I know what financing and investing, what those numbers are. And I backed into this number. Then I'm getting my net income number from the income statement. Okay, once I've gotten to this point, I'm going to add back any non-cash transactions. So depreciation is a non-cash entry. So we we depreciate equipment and buildings and things of that nature. There's no cash involved in that entry. So if we had $102,000 in depreciation, then we need to add that back because the depreciation decreased your net income by that amount. Think of it this way. If depreciation was the only entry that the company had for the whole year, then you'd have a net loss of $102,000. We know that there's no cash because there's no other transactions. So we need to add back 102 to get to zero from the operating activity. Now, what I just did is another tip that I'm providing to you in this video. Notice how I isolated one transaction. When you do this, think to yourself, that's the only transaction that happened in this company. And what effect did that transaction have on cash? You remember the three buckets: operating, investing, financing. Money's going in, money's going out. Well, based on depreciation, there's no money going in and out of any of those buckets. So I need to remove that distortion from the cash flow statement because my objective is to come up with the ending cash. We started with this much cash, we ended with this. So if we're using the indirect method, we start here and we're adding and subtracting non-cash transactions. And notice here we've got losses and gains on sale of assets. So if you had a gain on the sale of assets, say you sold a piece of property and you sold it for $129,500. Let's say you paid $100,000 for that piece of property. You made $29,500, and that increased net income. But that profit, we're going to remove that profit, and I'll show you why in a moment. The profit or the loss on the sale of that asset, we need to remove it. Now, why are we doing this? Because we've already dealt with the cash flows up here. So if you sold that if you sold that property for $129,500, then you're going to have proceeds from sale of the assets, and there would be a direct cash inflow of $129,500. So if we didn't remove the profit portion here, we've double counted. So we're trying to remove the non-cash transactions and items like gains or losses on sales so that we can truly get to the amount of cash from operations. Now, once you've done this part where you're dealing with non-cash transactions and, say, gains and losses, now we're looking at what I'll call changes in accounts. So when we go here to the balance sheet, we see, for example, accounts payable. Accounts payable went down from 301 to 41 from year to year. So if I go over here and I'm looking at increase, decrease of accounts payable, I see it went down 259,660. Well, that's the decrease from here to here. So think about it. You backed into this number. You know what this number is from the income statement. You add and subtract the non-cash transactions. Now you're moving into dealing with the changes in balance sheet accounts like accounts payable and receivables and inventories and accounts like that. Now, you've done all this work, and usually you're going to feel pretty confident about this number for the investing piece. You're going to feel confident about the financing number. So where would the problems normally lie? If your arithmetic doesn't give you the right answer here, usually the problem's going to lie in this section. What I see a lot of CPAs do or accountants do, they'll put the balance sheet in Excel. They'll have current year, prior year, and then there's a difference column in an Excel spreadsheet, and they're using that to get back over to these changes. I would do something like that. I think that helps you isolate the numbers. But I go back to what I said a minute ago, is when you run into problems, start isolating particular transactions. Usually you'll know there's 2 or 3 places you're not quite sure about. Go to those places and ask yourself, if that was the only transaction, how would that affect cash? Now let me give you an example. Let's suppose that the company received $200,000 in payments from its customers, and it didn't receive anything else. Well, we might have a net income number here of $500,000, but the question is, how much cash did we receive? If that's the only transaction, how much cash did we receive during the year? So suppose you had the $500,000 in sales, but you only got paid $200,000. That first bucket, the operating piece, only $200,000 went in that bucket. If that was the only transaction for the year, the $500,000 in sales, you'd have a net income of $500,000. Now you're going to have a change in receivables, and that's going to net back down to the $200,000 that actually went into the bank account. So you see how we're isolating those transactions to determine whether or not these numbers are correct. So I'm going to summarize these tips I've given to you. The first thing I said is start with those direct method areas like investing and financing, nail those numbers down first. Then you're going to know what your ending cash balance is from the balance sheet. You're going to know what your opening balance is. You can use those to back in your cash flow from operations. Then if you're using the indirect method, you're going to start with net income, then add and subtract your non-cash transactions. If you're struggling there, go to that second tip, which is to isolate each individual transaction. Pretend that there's no other transaction. How did that affect cash flows? And you'll recall we said we got accruals on the balance sheet, but we're dealing just with cash on the cash flow statement. Keep in mind you've got 3 buckets: operating, investing, financing. We got money either going in each of those or out of each of those. If you'll use those tips, I think it will help you create your cash flow statements. If you run into problems, usually the area you'll struggle with is that indirect piece where you're going from net income to cash flows from operations. So go there and see if you do have a problem there. So if you're still scratching your head, don't feel alone. I remember when I started doing cash flow statements, it confused me greatly. Still does at times, but I hope these tips will help you in the days ahead. So until we meet again, take care and bye now.